Yeah, well, I think we've had a pretty different start of 2025 than we had the start of 23 and 24. In 23 and 24, people were pretty pessimistic about what was going to happen with the US economy. It wasn't, the start of 23, there was a 100% probability of recession, which of course it didn't transpire. But what's happened as we enter 25 is people are extrapolating the pretty good economy that we've seen in the last few years and then some on expectations of not just good growth, but additional policy measures taken by the new administration that will further juice the economy. And so I like to say, we're entering this year with euphoric expectations just at a time when we've experienced a pretty meaningful market based monetary tightening with interest rates rising 120 basis points over the course of the last 6 or 8 weeks. And that combination of things is not a great setup for asset returns, at least to kick off 2025. Very high expectations, market based tightening. And it's basically what we're seeing, which is after a period where everything's gone up for a few years, basically stocks have been flat for 3 or 4 months now.
When you say it's an interesting return environment, help us set expectations because we've come off 2 double-digit years, and if I look into market history, well, there have only been, I believe, 4 times where we've had 20% returns in consecutive years on the market, and those actually haven't been precursors for bad years. It's kind of like you got enough momentum to keep it going. So, is the return difficulty that you see in terms of this environment, is it that you expect a downturn or do you expect it to be sluggish?
Well, I think when you're an investor, the question is around the universe of possible assets you could invest in. The last couple of years, it's been all about stocks, and if you had held, for instance, bonds in your portfolio, they were a drag. And I think that trade off between stocks and bonds, which really favored stocks over bonds for the last couple of years, is now shifting back to favoring bonds over stocks at these yield levels, and also continues to favor gold relative to stocks at these levels as well. And so I think it's less about an aggregate meaningful decline in asset prices, across the board, and much more about where do you want to put your risk right now, and does it make sense to be just a bit more conservative in terms of holding things like bonds and gold instead of stocks, or instead of all in on stocks the way people have over the course of the last couple years.